Hi everyone, I'm Krishna Karwa, a senior research analyst with iFAST Financial India Private Limited. At the outset, best wishes of the new year to you and your family members. What better way to start off 2022 than with a good product and one which we believe can be a fitting inclusion in one's portfolio. In today's video, we are talking about the Nippon India Nifty Auto ETF. To discuss more on this, I have with me Mr. Sameer Desai, who heads the ETF sales at Nippon AMC. With over 3 decades of experience in this industry, he is one man whose insights you would not want to miss out on. So without further ado, let me welcome him to the call. Hi Sameer, and best wishes of the new year to you as well.
Thank you, Krishna, for having me over, and best wishes and a healthy new year to all the viewers.
Thank you very much. So Sameer, coming to the Nippon India Nifty Auto ETF, can you tell us what the characteristics of the product are like, and what are the benefits one can look forward to?
Yeah, sure, Krishna. So let me start by summarizing the benefits of an ETF, which are well known, but I'll just reiterate some of them. So the product is low cost. One can invest small amounts in the NFO and post-listing. Since the underlying portfolio is a passive index, okay, the non-systemic risks of investing, that is stock selection risk and manager risk, gets eliminated in an ETF. Portfolio is always transparent because it is an index, and ease of transaction because one can buy and sell it on the stock exchange. So the current launch that we are talking about, which is the Nifty India Auto ETF, gives an investor an exposure to India's auto sector because the underlying portfolio is the Nifty Total Returns Auto Index. Okay, so this index basically represents the auto sector in India. Hence the objective of the scheme is to provide an investor returns that closely correspond to the total returns auto index before expenses, and of course subject to any tracking errors. Additionally, the most important point which I would like to emphasize on is that the index has a low correlation to the broad market Nifty 50, as well as a negative correlation to important sectors like IT, FMCG, metals, and so on and so forth. So for example, the correlation to Nifty 50 is 0.4, whereas the correlation to the IT is negative 0.5, which is an important sector. So that's why I'm talking about IT. Another important sector, FMCG, again, the correlation is negative 0.09. So benefits of correlation, as we know, are very important in portfolio construction and asset allocation, because asset allocation only works on the principle of low or negatively correlated assets. So these are some of the benefits of the Nifty Auto ETF, which we have just launched.
And yes, Sameer, as you rightly mentioned, this can complement one's investments in the typical core sectors such as BFSI and IT.
That's right. Absolutely.
Yes, Sameer. So there's in the passive space, typically most investors would flock to something like a Nifty 50 index fund or an ETF. Does Nifty Auto as an index have that potential to generate that alpha? Do historical results seem to indicate that?
Yes, Krishna. So, our analysis tells us that whichever way we look at the product compared to the Nifty 50, so that's whether I take a calendar year return or a rolling return analysis or a CAGR, the Nifty Auto index has done better than the Nifty 50. So let me elaborate on this. So if I consider the calendar year returns since 2010 till end November 2021, then out of 12, in 8 time periods, calendar time periods, the Nifty Auto Index has outperformed the Nifty 50. Okay, so majority of the times it has done better if I take the calendar year returns right from 2010. If I take the CAGR returns from the index inception, that is from January 2004 till November 2021, then even in this time period, the Nifty Auto Index has outperformed the Nifty 50 Index. So that's a CAGR return. And if I take a daily rolling, analysis, the time period, let's say from January 2004 index inception till November 2021, then whether I consider a 1 year rolling, daily rolling, or a 3 year, 5 years, 7 years, or 10 years, okay, whatever rolling time period I consider, the Nifty Auto Index has outperformed the Nifty 50 Index. So, so to summarize, whichever way you look at it, the returns look better than the Nifty 50 index historically.
That's quite interesting for a sector which hasn't been the most popular of the lot, but it indeed possesses the potential to give you that alpha.
Yes, that's right. So that tells you that it was an underdog and maybe deserves re-rating.
Absolutely, relative to other sectors which have just zoomed past the sky.
Yes, that's right.
Okay, so Sameer, next up is how does the stock composition look like in the Nifty Auto Index?
Yeah, sure, Krishna. So this is a 15 stock index representing companies from the auto two-wheelers, three-wheelers, four-wheelers, commercial vehicles, tires, as well as auto ancillaries. So, almost the entire auto sector is represented in this index. So for the benefit of the viewers, I'll mention some of the companies which form a part of the 15 stock index. So, you have the popular 2, 3, and 4-wheeler companies like Maruti Suzuki, Tata Motors, Ashok Leyland, Eicher Motors, Bajaj Auto, TVS. Then you have, tire companies like MRF, Balkrishna Industries. You have battery companies like Exide and Amar Raja Batteries. You have the auto ancillaries, like, for example, Bosch. You have Bharat Forge is a part of the index. Tube Investments is a part of the index. So pretty much every sector of the auto industry is represented in the index. So it gives the investor an excellent exposure to the auto sector in India.
And it's, of course, considerably cheaper to invest in an ETF, both in terms of expense ratios and capital versus investing individually. Absolutely.
Not to mention the low cost as well as the elimination of the non-systemic risks of investing.
And one more important aspect when one looks at ETFs in particular is the liquidity element. And now we know it's a niche product, unlike some of the headline sectors for which products are already available. So how does Nippon aim to address this issue, especially in case if sale volumes tend to be higher?
So Krishna, liquidity for any ETF is a function of the investor base and the volumes and the folios that you have. So let me share some statistics, of Nippon India in this space. So, for example, in the folio share in the ETF space in India, Nippon has a 60% folio share. In the daily average trading volumes of all ETFs traded in India, Nippon has a 70% market share. So whether it is the daily average trading volumes or the folios, we have a lion's share of the market in the ETF space in India. And this is simply because of the head start that we have had in the ETF space, a 20-year track record because of the acquisition of the benchmark/Goldman Sachs ETF business. Passive investing is a dedicated vertical with a dedicated team within the company. So all these factors contribute to high volumes in most of the Nippon ETFs. Let me share the actual statistics of one of our sector ETFs to give you a better idea, because auto is a sector. So let me touch upon one of our sector ETFs. So for example, bank ETF, the Bank B's ETF that we have, It has a daily average trading volume of almost 28.5 crores, and this is the 1 year number which I am quoting. Okay, and this is the NSE data, and this volume is higher than the combined trading volume of all the competing bank ETFs listed in India. Okay, so this gives you an idea of how a sector ETF trades. So I don't see any issues in the liquidity going forward. After listing, ETFs can be purchased in two ways. One is you go on the stock exchange and buy an ETF. Large investors can come directly to the AMC and create ETF units in creation unit size, which in the Nifty Auto Index will be 25,000 units. So I don't see, to summarize, I don't see liquidity as the as an issue in this particular ETF, considering our previous track record.
Some staggering set of numbers out there, and this is definitely going to be quite reassuring even for people who wish to deploy heavy capital in this space.
Yes, sure.
One more important point in the context of passive investing is the benefit of low cost, apart from the fact that, of course, you don't have fund manager biases coming in the way. For this particular ETF, what would the TER be?
So, continuing with our philosophy of offering low-cost passive products, the Nifty Auto ETF will have a all-inclusive TER of 0.22%.
Okay. And more importantly, how does one position a product like this in his or her portfolio?
So, as I said earlier, when you construct a portfolio, it is important to combine, ETFs or index funds having a low correlation or a negative correlation with each other. It is here that the auto fits beautifully compared to the broad market Nifty 50. It has a low correlation of 0.4, as I said earlier. If I consider the correlation with other major sectors like IT, FMCG, metals, then it is negatively correlated. So the low correlation makes it a very good portfolio building block, in portfolio construction. And that is how asset allocation can be practiced efficiently to give you a overall risk-adjusted return in the total portfolio.
We could not agree more, and I think you've touched upon all the aspects in the context of this unique product at length, and I'm sure a lot of viewers will be able to decide and act accordingly. Sameer, with that backdrop in mind, would you like to also express any concluding remarks?
Sure, Krishna. So, I am reminded of a, sentence that I used to read off, that what is good for General Motors is good for America. And General Motors, once upon a time, was the largest company in the US and the prime mover of the American economy. And General Motors was obviously an auto company. So what was good for GM was good for America. I think if I paraphrase the same sentence in case of India, what is good for the auto sector is good for India. Because the auto sector is a very, very important sector. It constitutes almost 49% of the manufacturing GDP and almost 7% of our total GDP. And it provides employment to a large number of people. And if I consider the ancillary benefits of the auto sector, then it spurs or stimulates credit growth. It gives employment to a large number of people in ancillary industries. So whichever way you look at it, it's a very, very important sector. And considering the fact that it was beaten down so far due to the COVID, due to the slowdown, semiconductor shortage, and so many reasons, I think all those issues are now past. And maybe now, if I may use if I may use an analogy, the auto sector is probably on the expressway. So going forward, if anybody wants to take an exposure to auto industry in India, the low cost Nippon India Nifty Auto ETF is, I think, the right space to look at.
Absolutely. In fact, everyone just talks about the exponential growth potential that India has to offer in terms of GDP. And that's where cyclical sectors such as auto can have a really meaningful role to play.
Yes, absolutely. You said it.
Yes. So on that note, we would like to wrap up the video, but not before thanking Sameer for taking out time and sharing such valuable insights on not just the sector, but the product as well. So we look forward to connecting with our viewers soon. Until next time, take care, stay safe, and have a great year ahead.
Thank you, Krishna, so much for having me over. And thank you, viewers.